Welcome, dear Wealth Protector, and we wish you well. We hope you are well this 2025. This is our first class of this year 2025, and today we are going to learn and discuss the clauses of motor policy. And we've chosen motor policy because this is the most consumed product in the insurance sector, and you will find that now motor vehicle has become a necessity in human life. And that is why if you look at the type of businesses that are involved in motor vehicle, like car hire, car renting, and PSV matatu, they are really doing well. And that's why if you look at most jurisdiction or countries, this is the most consumed product in insurance sector. So, and that's why we've decided now we can learn this clauses so that these customers who are consuming this product can be able to have easy time when it comes to the time of claim, so that they should not have any problem in getting their policy claims. You find that there are countries, like in my country, there's an act of parliament of Third Party Act Cap 405 that states that you must have a minimum insurance of third party if you are an owner of a vehicle. And that means that if you decided to buy a vehicle, you must have an insurance. And that's why I'm stressing here that this is the most consumed insurance. So people will just buy insurance because they are forced to. There are circumstances that can also make you buy a comprehensive insurance without even having a need of that comprehensive insurance. One, maybe if you bought a vehicle which is financed with a bank or a SACCO, those financiers must make sure that vehicle is comprehensively covered before you take it from the showroom. Or maybe if you use your vehicle as a collateral for finance, or you've taken a loan somewhere, that vehicle must be comprehensively covered. And that's why we are saying maybe you can just find yourself buying this policy without even understanding the benefit that you can get from it or the clauses that are governing that policy that you've bought. So welcome to our class. If you've not become a member of this class, be sure by subscribing down there, and once you do that, you just joined our club of wealth protectors and money matters. And in any time we give a class, you'll be getting a notification that you'll be able to learn and boost your knowledge of wealth protection and money matters. Welcome to our class, and thank you for keeping it here. The first clause is average clause, and this average clause only applies in a situation where the insured, or you as the owner of the vehicle, has underinsured your vehicle down from the actual market price of your vehicle. Let's assume your vehicle is 1 million and you've insured your vehicle at a price of 800,000. So it means you've underinsured your vehicle at a price of 200,000. So once there is a claim for repair or total loss or theft, you are going to bear that percentage of the value that you didn't insure. For this case, you didn't cover 200,000 of the value of your vehicle. So you are going to bear the cost of that repair or the cost of total loss of your vehicle at that rate of 200,000. If you take it in a mathematical form, you will get that if you insure like that, you will be giving an insurance company 80% of the market price of your vehicle and remaining with the 20%. So once or anytime there's a claim and it's realized that you underinsured your vehicle, you are going to bear the 20% of the repair cost or the 20% of the cost that you are supposed to be paid. So anytime you are buying this policy of comprehensive, make sure you get the right market price of your car that you can easily insure. And that's why most of underwriters, they usually get a valuation or a valuer to value that vehicle before 3 months. And once that one is done, they usually advise the clients to adjust the premium according to the value of the vehicle that they've found. So if in bad luck you insure your vehicle and something happens, you are also going to contribute in paying your claim with the portion that you didn't insure. Clause number 2 is excess clause, and this excess clause is the amount or portion of claim that the insured is supposed to pay before the company pays a claim that they've launched. Like for example, in most cases, like private vehicle, the excess that they're supposed to bear is 2.5% of the value. If it is a commercial vehicle, it is 5%. and mostly the public service vehicle, that is PSV, they usually have an excess of 10%, 7 to 10%. So if a claim happens and maybe your vehicle is supposed to be repaired at the garage or it's a total loss, you are supposed to bear that percentage of 2.5% or 5% or 10%, and that is what we call excess. And mostly these excesses are imposed so that they can limit the minor claims. Like for example, if your excess is 30,000 and you have a claim of 10,000, there's no need of claiming because there's no need of paying 30,000 and the underwriter will pay 10,000. So you can just repair that vehicle and save the 20,000 that you are supposed to have paid in that claim. So in other cases, there are companies that have given an excess protector policy that you can buy to protect that excess that you're supposed to pay when a claim happens. So it means if when you buy an excess protector cover, it means in any time you get a material damage claim, you'll not pay excess. That policy will pay on your behalf, and once you've done that, you shall have taken care of that clause very well, and you'll be enjoying that policy that you bought for your vehicle. The next clause is about loss ratio, and loss ratio is a way most of underwriters usually measure how much they've paid to you or to any customer that they have as a cost of claim versus the premium that you've paid, and that is what we call loss ratio. In that, in a year, they'll look at you at like how many claims have you given them, how much have they paid back to you, and how much premium did you pay them. Like for example, if your vehicle is comprehensively insured and at $1 million, and maybe within that year you claimed up to 300,000, and the premium the premium you paid was 50,000. So that is how they'll be looking at you. You'll have certain percentage of loss ratio, or maybe you had a total loss and the premium you paid was only 50,000. So sometime this loss ratio will help you this way. If you have a big percentage of loss ratio, the companies may decide to load premium to you. We are going to learn that one in the next clause. Or sometime when you don't claim so much, they can give you a discount, or they can maintain the premium that you had before the renewal time comes. So it means if your loss ratio is high, chances of the underwriter increasing premium to you is also high, and sometimes they can even refuse to renew your policy. Sometimes you'll find that they can even flag some customers who are fond of claiming. There are customers who are just nicknamed as claimant. They give you a premium, within 2 months there's a claim, within some weeks there's a claim. They can flag you and refuse to give you a comprehensive. The only policy that you can buy is only third party. So you can only be gauged in terms of the money that the company is paying to you and the premium that you are paying them using loss ratio. There's also another one which is called premium loading, and this one is just having an additional cost on your normal premium that you're supposed to pay. This one only happens during the time of renewal of your policy. Like for example, if you had so much claim, or if you had a claim, the underwriter can decide to load a premium, maybe 5% or maybe 2.5%, depending on the loss ratio that you had. So if you realize that maybe when the time of renewing your policy, you find that your premium is more than what you paid the previous time, maybe you can ask yourself, did you have a claim, or is there something that happened to you between you and the company in terms of claim payment? So if any accident happens and maybe loading is done, they're just trying to make sure there's a commensurate between the premium you're paying and the claims that they're paying out. There's also another clause about contribution, and contribution normally happens when maybe you've taken more than one policy for the same vehicle in different companies, and that one was there before, but currently it cannot happen because most of these certificate of motor vehicle insurance, they are usually taken from one organization, and once you've taken a policy in company A, you cannot get the same insurance of that vehicle from another company. So the double insurance cannot happen now in Kenya, in country Kenya, maybe in other countries. But if it happens in other countries, when an accident occurs, they usually a contribution. You cannot be given 100% claim in company A at the same time you get it from a different company. Those companies will come together when an accident happens and they contribute towards your claim. The next is cover endorsement or policy endorsement. Like in this comprehensive cover for motor, there are additional benefits that you can buy from your comprehensive vehicle, like windscreen cover. You can get as an additional benefit, radio cassette, excess protector, even loss of use. So those extra cover, once you've claimed those extra covers, let's assume you've experienced a windscreen crack and then you claim, and that claim is paid. You can claim windscreen separately, even radio cassette separately. Once that one is done, most of this policy lapses. So you are supposed to pay an additional premium so that this cover of windscreen or radio cassette can be endorsed. And that's why that endorsement clause is there. So it means anytime you enjoy a benefit of claim of windscreen, once you've been compensated, you are supposed to endorse for the rest of that period of that policy, even to radio cassette. If you don't do that, it means if you have another crack, or maybe your radio cassette is stolen, it will not be paid. Your policy shall have lapsed. We are going to learn that one in the next clause. The next one is cover limit lapse, and that is what I've just mentioned, that once you've claimed windscreen, once you've claimed radio cassette, and the period of that motor is still running, that benefit lapse. So you are supposed to endorse. So that lapse clause is taking care of that. So it means anytime you claim a windscreen separately, if it is not an accident case, or radio cassette if it is stolen, only that claim you are supposed to endorse that policy, because the moment it's paid, it elapses. Same to comprehensive there's a total loss. So once the policy has been paid a total loss, that policy lapses. And there's also another class here that we learned that those vehicles that have been written off from an accident, when you buy them back as a policy holder, you cannot get a comprehensive cover for that vehicle. You can only get a third party. There's also another one of young and inexperienced driver clause. When you find yourself in a situation, maybe you are less than years that are required for experience. Like for example, those people are driving private vehicle. The experience that they should have is 2 years and above. Those who are driving PSV vehicle, the passenger service vehicle, they are supposed to have 5 years, and at the same time they must be licensed as PSV driver. So if you have those licenses, it means you are now experienced. But if you don't have that, if you get yourself in an accident with using a vehicle, you are going to be forced to pay an excess on that one. And that one will apply if maybe your vehicle is driven with somebody still young, below 18 years. It means you are going to contribute on that paying of that claim. Sometimes some company may reject to pay that claim, not depending on the policy of that company. But normally there are excess that are imposed that the insured is supposed to pay when the vehicles that they are reporting that they had a claim was being driven with a young or an inexperienced driver. Another thing to note, there are some cases where you can get special rates, you can get special benefit from an underwriter when you name the driver that is going to drive that vehicle. Let's assume it's an organization and there are specific drivers. You name them when you are filling that proposal form, that they're the only people who are going to drive that vehicle. Sometimes you can get discount in premium, you can get other benefit, or you may not be loaded a premium when an accident occurs. So sometimes it's good, maybe if you have a vehicle as a family, you can just name maybe between you and your wife, or between you and your husband. You are the main drivers of that vehicle. You can get that benefit in your policy of motor. There's also another clause that sometimes is bringing a lot of complication during the accident, the depreciation and tear and wear clause. Sometimes maybe your vehicle can get involved in an accident. Maybe the tire were not that new, they were old, or maybe the battery that you're using was almost getting worn out, and then when that vehicle maybe is repaired and you are supposed to take it back, and the assessor now decide that you cannot use that tire or that battery cannot be used on that vehicle, so the assessor advises that you're supposed to get new tire. It means you need to contribute because the tear and wear is not covered, or the damage of that tire was as a result of maybe being worn out or not accident. So it means when an assessor give a value of repairing that or of replacing that tire, maybe if it is 12,000, you can share that cost 50-50 with the underwriter. So you pay 50% of that and the underwriter pays 50. Same to the battery of that vehicle, or there are some parts that can just get worn out from tear and wear or depreciation. The last clause we are going to talk about is non-claim discount, that is NCD, and this clause protects you whether maybe you have loss ratio of a higher loss ratio or a lower loss ratio. So if you have that benefit of non-claim discount, it means whether you have more claims or not, it means the following year when you are renewing your policy, you are supposed to get a discount. And sometimes this clause is usually directed with the regulator. Sometimes they can say this class of business charge this rate, but after every year give them a non-claim discount of maybe 5% or 10%. But normally it depends now with the underwriter. Some of them, they normally give you a rate which is minimum of non-claim discount. So when you have that rate, it means when you have a big loss ratio, they are free to load your premium when you come for renewal. And that is it, Wealth Protector, from our desk of wealth protection and money matters, our first class of 2025. That is how you can easily understand these clauses. There are more. Maybe if we get time, we'll discuss about it. And if you have this knowledge, you'll be able to help yourself when there's a claim. And if you have benefit of having an insurance agent or broker, he'll be able to advise you in each and every step of your claim. So don't worry. In Kenya, you can get yourself an insurance agent. We also insurance agents in Kenya. We trade using a name of bonfriinsurance agency. So if you don't have an agent, you can contact us. We can give you that total service and advice as required. Thank you for keeping it here. Thank you for subscribing. See you in our next class, and we promise to help you understand this risk management clause and skills in your financial life. See you in our next class.